What if I told you that you could be throwing away $28,000 over the next 30 years without even realizing it? Today we're diving into one of the biggest decisions every investor faces: VTI versus SPY versus VOO. Three ETFs, nearly identical performance on the surface, but vastly different outcomes for your wealth. Here's the mystery. One of these funds costs 3 times more than the others, yet it's the most traded ETF in the entire world. By the end of this video, you'll know exactly which ETF deserves your hard-earned money and why millions of investors are making the wrong choice every single day. Let's get into it. Quick favor, hit like and subscribe right now so YouTube shows this to more people who need to see it. First, let's meet our 3 contenders. SPY, the SPDR S&P 500 ETF, is the OG champion. Born in January 1993, this was the world's first S&P 500 ETF, and it absolutely revolutionized investing. Even today, it trades 79 million shares every single day, making it the most liquid ETF on planet Earth. SPY is the heavyweight champion that everyone knows. Then we have VOO, the Vanguard S&P 500 ETF. Launched in September 2010 as Vanguard's answer to SPY's dominance. Here's the plot twist. VOO is now the largest S&P 500 ETF in the world, with $790 to $823 billion in assets. That's right, the challenger has become the champion. VOO is the silent killer, systematically overtaking SPY. Finally, there's VTI, the Vanguard Total Stock Market ETF. This one's different. While SPY and VOO track only the 500 largest U.S. companies, VTI tracks the entire U.S. stock market, with 3,533 individual holdings. VTI is the diversification beast, going way beyond what the other two offer. Now here's what makes this comparison fascinating. All 3 funds invest in U.S. stocks. All 3 hold the same mega-cap tech companies at the top: Apple, Microsoft, Nvidia, Amazon. All 3 have made investors incredibly wealthy over the past decade. So if they're all so similar, why does your choice matter so much? Because the devil is in the details, and those details could cost you a new car, a year of college tuition, or even a down payment on a house. Let's talk about the elephant in the room: expense ratios. VTI charges 0.03% annually. VOO also charges 0.03%. But SPY? SPY charges 0.0945%. Now you might be thinking, wait, that's only a 0.06% difference. We're talking about pennies here. Who cares? Well, let me show you why you should care deeply. Let's run a simple challenge. Imagine you invest $100,000 today and leave it alone for 30 years. We'll assume a 10% annual return, which is roughly what the stock market has delivered historically. With VOO or VTI at 0.03% fees, your $100,000 grows to $1,730,720. With SPY at 0.0945% fees, you end up with $1,702,614. The difference? $28,106. That's not pocket change. That's a decent used car. That's multiple family vacations. That's real money that simply evaporated because of a tiny fee difference. But here's where it gets truly mind-blowing. Watch how this damage compounds over time. After 5 years, you're only behind by $439. Barely noticeable, right? After 10 years, it's $1,408. Still doesn't seem terrible. After 15 years, $3,392. Now we're getting somewhere. After 20 years, $7,263. Okay, this is getting serious. After 25 years, $14,582. And by year 30, you've lost $28,106 to fees. This is the power of compounding working against you. The fee difference is small, but compounded over decades, it becomes massive. So why does SPY cost so much more? It comes down to structure. SPY uses something called a unit investment trust structure, which is basically old technology from the 1990s. This structure cannot reinvest dividends between payment dates, creating what's called cash drag. It has limited opportunities for securities lending, which could generate revenue to offset costs. Meanwhile, VOO and VTI use a modern ETF structure that's simply more efficient at managing money. This isn't about greed. SPY's higher cost is a structural inefficiency baked into its DNA.
Now, let's talk about what you actually own with these three funds. VTI holds 3,533 stocks, representing the entire U.S. market. SPY and VOO each hold exactly 504 stocks, tracking only the S&P 500 index. On paper, VTI sounds way more diversified, right? 3,533 holdings versus 504. But here's the twist that most investors don't understand. 80 to 88% of VTI's assets are invested in the exact same large-cap stocks that make up the S&P 500. Only about 12 to 20% of VTI represents those extra 3,000 companies. Let's look at the top 10 holdings. In all three ETFs, you'll find NVIDIA at roughly 7%, Apple at 6%, Microsoft at 5.9%, Amazon at 3.6%, and the other tech giants filling out the rest. But here's where it gets interesting. In VTI, the top 10 holdings represent 32% of your portfolio. In SPY and VOO, those same 10 stocks represent 45 to 50% of your money. So yes, VTI is more diversified. But all three funds are still heavily concentrated in mega-cap technology companies. What about those extra 3,000 companies in VTI? They include mid-cap companies valued between $2 and $10 billion, representing about 5.1% of VTI's assets, and small-cap companies under $2 billion, representing about 1.2%. When small caps rally like they did in 2010 and 2020, VTI outperforms. But when mega-cap tech dominates like it has recently, VOO and SPY pull ahead. The recent one-year returns prove this. VOO returned 13.31%, SPY returned 13.29%, but VTI lagged at 12.25%. Large-cap technology dominance gave the S&P 500 funds the edge. Let's look at the long-term historical data, because this tells the real story. If you had invested $10,000 in January 2010 and held until the end of 2025, here's where you'd be. With VOO, your $10,000 would have grown to $82,119, a 721% total return, averaging 14.82% per year. With SPY, you'd have $81,215, a 712% return, averaging 14.74% per year. With VTI, you'd have $78,144, a 681% return, averaging 14.45% annually. Notice the pattern. VOO and SPY track almost identically, but VOO edges ahead by about $904 thanks to its lower fees. Meanwhile, VTI trails both by nearly $4,000. Why? Because the past 15 years have been dominated by large-cap growth stocks. The mega-cap tech companies that dominate the S&P 500 have absolutely crushed it, while small and mid-cap stocks have underperformed. This doesn't mean VTI is a bad investment. It means the market environment matters. If small caps outperform over the next decade, VTI could easily take the lead. Now let's address why SPY still exists, despite costing 3 times more. The answer is liquidity. SPY trades 79 million shares every single day. VOO trades 7.3 million shares daily. VTI trades 3.7 million shares daily. SPY has 21 times more trading volume than VTI and 11 times more than VOO. For bid-ask spreads, SPY typically shows 1 penny spreads, while VOO and VTI show 2 penny spreads. For most investors, this difference is completely meaningless. But for active traders moving in and out multiple times per day, for options strategists who need the deepest possible options market, and for institutional investors moving millions of dollars instantly, SPY's liquidity is worth the premium. Here's the key question. Are you one of those people? If you're a buy and hold investor making monthly or quarterly purchases and planning to hold for decades, SPY's superior liquidity does absolutely nothing for you. You're paying 3 times the fee for a feature you'll never use. And here's proof that everyday investors are catching on. VOO has dethroned SPY as the largest S&P 500 ETF, with over $800 billion in assets, compared to SPY's $708 billion. Investors are literally voting with their money. Fees matter more than brand names.
Let me make this personal with 3 real-world scenarios. Scenario 1. You're 25 years old and invest $200 per month until age 65. That's 40 years with a 10% annual return. With VOO, you'd retire with $1,253,329. With SPY, you'd have $1,230,688. The cost of choosing SPY? $22,640. That's almost a new car that you gave away to fees. Scenario 2. You're a mid-career professional with $50,000 to invest as a lump sum for 20 years. With VOO, that grows to $334,545. With SPY, you get $330,913. You just lost $3,632 to fees. That's a really nice vacation you'll never take. Scenario 3. You're an aggressive saver investing $500 monthly for 30 years. VOO gives you $1,123,037. SPY gives you $1,108,774. The difference? $14,263. That's a full year of college tuition gone. So which ETF wins? For 70 to 80% of individual investors, VOO is the clear winner. It offers the lowest cost at 0.03%. It's now the largest S&P 500 ETF in the world. It has excellent liquidity for regular investors, and it's recently delivered the best performance. VOO is the perfect balance of everything most investors need. Choose VTI if you specifically want true total market diversification with exposure to those 3,000 companies beyond the S&P 500. VTI costs the same 0.03% as VOO, but gives you broader exposure. If you believe small and mid-cap stocks will outperform large caps over your investing timeline, VTI is your fund. Just understand that recently it's lagged behind due to large cap dominance. Choose SPY only if you're an active day trader, you regularly use option strategies, or you're an institutional investor needing maximum liquidity. For this tiny fraction of investors, maybe less than 5%, SPY's premium cost is justified. But if you're a typical buy and hold investor, choosing SPY means you'll literally lose tens of thousands of dollars over your lifetime for a feature you don't need. Here's the bottom line. All 3 of these ETFs will make you wealthy if you invest consistently and hold long-term. The U.S. stock market is the real winner here. But why would you voluntarily pay 3 times more in fees for the exact same exposure? VOO has dethroned SPY for a very good reason. It's simply better for most investors. Now, if you already own SPY in a taxable account, consider the tax implications before switching. But if you're starting fresh today, VOO or VTI are the obvious choices. But remember, the most important decision isn't which ETF you choose. It's that you actually invest and stay invested. The real enemy isn't picking the wrong fund.
It's not investing at all. Drop a comment below. Are you Team VOO, Team VTI, or Team SPY, and why? Hit subscribe for more investing breakdowns that actually matter. Now go build that wealth. This video is for educational and informational purposes only. Investment performance shown is based on historical data and projections. Past performance doesn't guarantee future results. Always conduct your own research and consult with a qualified financial advisor before making any investment decisions. Thanks for watching.